Sonam Udasi is here with us to talk about the fundamentals as well, Head of Research at IDBI Capital. Sonam, good to have you. Thanks so much for joining in. Let's start off with the big ones that came out during the day. ICICI Bank, the result reaction, 2.5%. The optimist would probably say a bit muted by virtue of the kind of NPA performance purely that the company showed. What did you make of the numbers, and how would you look to trade or invest into ICICI Bank post this quarterly performance?
Frankly, I must admit that the numbers, at least on the PAT side, were better than our estimates. We were estimating close to about 1.72 billion, and it came slightly ahead of that. That said, also, on the NPA side, I think people were expecting this kind of news flow to come in, and I think the management themselves had indicated earlier as well in the earlier quarters on this. Our own sense is that overall on the banking pack, there will be headwinds going ahead as well. Our channels checks suggest that the stress asset scenario has diminished. I mean, it has peaked out in that sense, but there is still a lot of stress despite the 50 basis point cut, etc. by the RBI, and that sort of will continue into the next 2 or 3 quarters. Also, the fact is that most bankers have not admitted that credit growth this year is not going to be bigger than 15% for most banks. So here the investors are really not really looking from a growth perspective. They are merely looking at from a asset quality perspective, and that in that range, I think banks like HDFC Bank score over the ICICI Bank or the Axis Bank. That said, we would be buyers on ICICI at 10% lower from here.
Fair enough. What would your call on Axis Bank be, Sonam?
See, on Axis Bank, we have an accumulate rating, but we prefer ICICI Bank over Axis Bank at this point in time, simply because our view is that while the negatives on ICICI Bank are largely known and sort of discounted, there is the fact that Axis Bank has grown its balance sheet very aggressively over the last 4 or 5 years. There is this expectation that it may face some sort of stress on the books as the year progresses, and that question mark is sort of playing out. So in our view, as a risk-reward trade-off, we would chase ICICI Bank versus Axis Bank at these levels.
Okay, some trading ideas as well, but before that, Sonam, what do you make of the weakness that is persistent on the infra names over the last 3 or 4 sessions? There's a sudden amount of selling that is happening in financing as well as pure play infra companies, and it's continuous for the last 4 or 5 sessions. What's happening here?
If you remember, the first 2 months saw a real big rally on all the infra names, whether it was utility related or pure play construction or airports, etc. In the expectation that the environment on policy will become better from here on, and valuations are far too attractive, and therefore there is certain amount of interest. What is visible on the ground really is that there is not much order booking that is happening, and the policy is not very clear when the order book will start to flow in. Also on the receivable fronts, many of these companies are faced with some amount of receivables, and the debt equity scenario does not seem to be improving over the near term, and I think that's where investors have taken a call and got out of risky assets. Globally now there is a syndrome that after the risk-on strategy which investors adopted, generally globally everybody is re-evaluating that, and there is some amount of risk-off strategy. There are concerns on Europe, etc. resurfacing, and therefore you see this momentum even in the Indian markets. If you see the market trend, I think the market and the participants are going for visibility. So as you mentioned that all these businesses are varied businesses, so anything to do with India consumer and there is some visibility on growth and EBITDA and cash flow perspective, I think investors are fine with that and are not really nervous on those. and any sort of drop in these names will again bring buyers into and to take their positions up. That said, there exists this worry that if there is a slight amount of downturn over the next three or 6 months, because most of these companies have had amazing pricing power in the last 2 years. They have had good volume growth and they have had the ability to pass on the inflation to the consumers. And so far, the consumption has largely remained price inelastic. So if we see some sort of weakness there, I mean, if you saw Nestle's results yesterday or day before yesterday, there it showed some sign of slowdown in what they were doing in terms of volume. So if that were to continue over the next 1 quarter, I think a lot of these P's will then come under stress. So right now I wouldn't be a big buyer. I would only be using this as a defensive bet till my outlook on the Indian market improves.
Sonam, how would you look at the large cap as well as the mid-tier IT lot?
The recommendation largely remains the same. Among the large caps, TCS of course is one of the top picks. That said, our top pick, whether it's mid cap or large cap, will remain HCLT, simply because there is some volume momentum which is available in their guidance. Also, their margins are likely to sustain, and they will be able to grow above the NASSCOM guidance, which is quite decent. We would be very bullish on HCLT, then move on to TCS. Infosys, we are not sure, while it has corrected quite a bit, we don't see much legs for it to regain that premium because the body language continues to be very meek. So unless they change that in the next quarter, I don't think we are going to change our view. Also, some of the mid caps names have run up quite a bit on expectation on the dollar and the performance, etc. And some of the names are up 30-40%. So I think it will be better to if you are holding them to just take a profit. If you are not holding them, then wait for some time. I think there will be some amount of correction and rethink on where they are going, and then take a view on that.